Well, welcome back, James. It's been a while since we've had a market update for our folks, so thought it would be a great time with all the uncertainty to really give a really certain market update
There you go.
of what is happening in DFW right
But it's
now.
it's a good time of year if nothing else.
Yeah,
We've
right.
spring break is in the rearview mirror, so here we go.
We were talking about this earlier, but things are just at a point where it's people have kind of accepted this is the way that it is. And then once we start to trend in a direction where we all get excited, something comes to temper our expectations.
Yeah, I think we talked about that in a previous sit down where it was May of 2022 where interest rates creeped over 7%. And that was the first time that had happened since George W. Bush's first term in office. So you literally had an entire generation of potential home buyers who had no philosophical concept of a rate that started with a 7 or anything above that. And that really brought the market to a grinding halt. And that trend just kind of continued to march all the way really through fall of 2023 when rates got into the mid eights. And we've seen a pretty consistent downward trend since that time, 2+ years now, to the point where really, I would say last year, the market got very psychologically comfortable and accepted the reality of this is where rates are. For most of 2023 and 2024, most of the conversations that I would have related to pre-qualifications, there was some element of, I'm sorry, the rates what?
Yeah, but I'm gonna stop you there. What are the rates today, so that people just kind of have an idea of what you're seeing like this week?
We're roughly in the mid sixes.
Okay.
Obviously that comes with the asterisks and the caveats of depending on credit score and property, purpose and occupancy and all kinds of stuff. But if you want no discount points or very minimal discount points, and you kind of check all the boxes that an ideal transaction would check, roughly the mid sixes right now, which has come down about half a point really in the last month or so.
Yeah.
We had gotten to the point where really this time last year, we started a very consistent trend of just rates coming down a little bit month over month. By the time we'd gotten to the tail end of February, as many people saw on the news and so forth, we were basically right at about 6%, 6.25, 6 1/8, 6%, somewhere right in there. That was, again, the last day, business day of February. March and spring break was right around the corner. I think everybody was like, okay, we're finally going to have come through this.
Yes.
It's all over. Here we go. And that was on Friday, February 27th. On Saturday, February 28th, the United States started bombing Iran. And by the time the markets opened that following Monday, we had spiraled out of control. And rates that were almost to 6% at the tail end of February, really by the tail end of March, were basically back to about 7%, high sixes, almost 7% again.
I know I was shocked last week. We're working a buyer and we're talking about their numbers and you're telling me the rate. And I'm like, what? Like, and it's crazy because it's right when we kind of settle in and go, okay, we're good. We're going to be good. It's something else, what did they say? It's not unforeseen, but whatever the term is,
Yeah, just nobody has a crystal ball for this kind. Maybe we should have a crystal ball when it comes to
unprecedented. I think
issues
it
in the
was.
Middle East.
Everything
Yeah.
was unprecedented.
But the good news is we've gained back about half a point of the point that was lost, and, so we'll see, as we're filming this on what's today, April 15th, we'll see what happens with Iran and the Middle East over the next, few weeks or next couple months. My expectation would be that if we kind of get all of that in the rearview mirror, I think we'll see some positive retreat back to those low sixes fairly quickly.
Right about the time that Jerome Powell's going to be leaving.
Yes, so that's an interesting discussion in itself.
Yeah.
Of course, Jerome Powell, the current head of the Federal Reserve, installed into that position by President Trump. Over the last year, President Trump has probably been Jerome Powell's biggest critic.
Yes.
And he has tapped a gentleman by the name of Kevin Warsh, who actually next week, I believe April 21st, will go before a committee hearing to, in theory, be confirmed. And then roughly mid-May, Jerome Powell would exit stage left and Kevin Warsh would take over. And that was a little bit of a surprise pick because one of the reasons that President Trump was so critical of Jerome Powell, and by extension, the Federal Reserve's Board of Governors in general, was he felt they were acting too slow and should have lowered the federal funds rate much faster than they did and much sooner than they did. So the assumption was that the Trump administration would replace Jerome Powell with somebody who, for lack of a better way to phrase it, would do Trump's bidding.
Right.
Well, Kevin Warsh is not really that guy on paper. He's actually been fairly hawkish. He's a member of a senior fellow with the Hoover Institute, which is a pretty conservative think tank out of Stanford University in Northern California. And he has been on record kind of calling for not having any rate cuts.
Right.
So it'll really be kind of interesting,
How the timing all works out with everything too, because
Yeah.
it could almost look like he's not as concerned if the timing's just right, because if he's coming in about the time that we hopefully get out of Iran, then here we are where rates are coming down and it looks like he's doing it. Everybody's getting excited. It's like, no, actually that's not the case.
Well, then you throw in midterm elections coming up this fall, and there's a lot of, the Federal Reserve, of course, is supposed to be an independent, neutral, bipartisan body. Usually doesn't work that way, regardless of what who's in the White House. But yeah, there's a lot of factors at play there that'll be interesting over the coming months to see what really does happen with some of that.
And it is definitely affecting how buyers are operating in the market for sure. I'm pretty listing heavy this year, but also having buyers in the market. I'm having to still direct quite a few of those first-time home buyers to new construction because they can offer the lower rates. But then even like having a buyer just in the pre-existing market, what they're able to leverage with a seller, what they're able to get back, how much we're getting. I mean, I'm making deals on $300,000 homes that are $40,000 apart, and we're getting pretty dang close on some of them to making it happen. And so that what it tells me is even with the higher rate, if I can get closing costs and you can buy the rate down, we're still able to achieve these payments, and people are getting into home ownership far cheaper than when those rates go down and then the price of a home actually goes up because of the affordability piece of it.
Yeah, and to that point, one of the things that we're starting to see in the mortgage space when it comes to interest rates, particularly with government loans, FHA loans, VA loans, we're starting to see pretty reasonable rates that have a lot of what we would call premium, but essentially are funds that can be used to pay closing costs for the buyer. Really during 2022, 23, 24, 25, we really weren't seeing that. The rates were so compressed that there just wasn't any value there for a buyer. Whereas now, especially again with those government loans, we've been locking on a number of borrowers that the lowest rate that didn't have any discount points also coincidentally paid back a point or something, 1% of the loan amount, which that can cover a lot of closing costs for somebody. So that's helping a lot, especially your first-time home buyers, folks like that, be a lot more aggressive in the market with what they can do.
Well, and just kind of some other interesting things like these little pockets like Godly can go USDA. And so you've got these situations where somebody can have literally $0 out of pocket. In fact, I've got a really cute little listing coming up next week in Crescent Estates in Godly. So it'll qualify for USDA, which would be amazing for a first-time home buyer who can come in. And then we can ask that seller to pay some closing costs. And then they can literally get into home ownership with like an inspection cost.
Yeah, and that's, when we think of a USDA loan, which of course stands for United States Department of Agriculture, there's the thought process, well, this house must be in the middle of nowhere to qualify for that loan. And historically, when we think about Dallas-Fort Worth, where we are, here in the middle of Tarrant County, we don't think very agricultural and rural for where we are, but so many parts of the DFW Metroplex, getting into Ellis County, Johnson County, Parker County, Wise County, are just growing so fast that the USDA maps are kind of not keeping up with the reality of the growth. So you have tons of areas that, have an HEB grocery store down the street that are not rural really in the slightest bit, but they qualify for a USDA loan because it wasn't that long ago that they were a rural property.
Yeah, and then like I said, it gives somebody the option who's got good credit, but they haven't quite saved up whatever they think their down payment should be, which I know there's a lot of faux pas around down payment. There's all kinds of ways to get into a house for 3.5%, 5%. It does not have to be 20%.
Yeah,
like
even
a lot
3% on a conventional loan sometimes.
And so people think I have to have all this money to buy a house, but there really is, if you've got the right agent and the right lender, you're able to lock in to a situation where you can become a homeowner and essentially have a mortgage payment that would be less than your rent that you're paying.
There are a lot of, in fact, I received a contract for somebody yesterday purchasing a home with an FHA loan. Right now, they had a little more than the earnest money in the bank. They had just enough to write that earnest money check, but they did a 6-week close date on the contract. Well, for someone who gets paid every 2 weeks, kind of the conversation we had is, batten down the hatches for a couple paychecks here And because they were able to get the seller, all the closing costs are covered by a seller concession. Again, it's an FHA rate where the rate has a pretty good amount of premium. So that was contributing. So really all they needed was their 3.5% down payment.
Right.
They basically already paid 1% of that in the earnest money. And so it's like, hey, just be methodical and frugal for 30 days, save a couple of paychecks, and you're good to go.
Well, and I don't know if it's just my little focus group that I'm currently in, but a lot of my buyers, I actually just closed my youngest buyers ever. I teased some friends of mine that were my youngest buyers that they've now been unseated by the 19 and 21-year-old. And I'm looking at my 19-year-old son like, when are we buying a house, buddy? But I'm like looking at this younger generation, and it's almost like they're more driven into homeownership than some of us millennials or elder millennials that are a little more scared to get in of like, well, I just don't want to own anything. You've got these younger kids that are like, no, I want to be in homeownership now.
And I think some of that is because they never functionally knew those 2%, 3%, 4%,
Right.
5% markets. So to them, this 6.5 rate that if you're 45 years old might make your eyes pop out of your head. But if you're 25, you're like, I was in college 6 months ago. Like, I don't know what a mortgage rate is.
Yeah.
This is what houses cost. Let's
And
buy
this
a
is what I
house.
can afford, right?
Yeah. So there's almost kind of
Which is going to serve them so
Yes.
well going forward. It's going to make it easier for them to make. I feel like those 2 and 3% rates were kind of such. If you're in one and you're planning to stay there forever, congratulations, right? Like that was the best thing that ever happened to you real estate wise. However, if you ever wanted to make a move again, it psychologically has done so much damage because you don't want to leave your home that you're in because of the rate is so good, even though you do want to move up. And so it's created almost more harm than good in a lot
Yeah, I
of
mean,
ways.
it's the proverbial golden handcuffs.
Yeah.
But we are starting to see a world where people are starting to get more comfortable leaving that 3.25% rate behind. And I don't think people were willing to trade for a rate that started with a 3 for a rate that started with an 8, or that started with a 3 for a rate that started with a 7. But we're starting to see people are more comfortable mentally with a 6% rate or 6.5 or whatever. In a large part because if you've owned that, especially if you owned that home pre-COVID and maybe you just refinanced into that 2.75% rate, but you've been in that house for any length of time, the amount of equity you probably have built up is tremendous.
Right.
And so selling that house, and whether you purchase on a contingency, which we can talk about a little bit, that those are kind of becoming cool and trendy again, or you're getting qualified with both house payments, and then after you move into your new home, then you sell your current, dump a huge amount of money on your principal balance and do what is called a recast in the mortgage industry. People are able to come up ultimately with payments where, even though the rate is quite a bit higher than what they're leaving, the sticker shock on the actual payment is not that bad, relatively speaking.
Right. And the drivers are, they're there. Like kids are moving. I know for me, I mean, I was in a 4 something rate whenever I sold, and now I'm in a 6.45, I believe. But for me, Hudson was leaving. I wanted less upkeep. I had, a desire to be somewhere else. And so it was like, I don't care about the rate. It's time to move kind of deal.
Well, and that's one thing I routinely tell people, when they ask me, what do you think? What do you think about this rate? Or do you think we should lock? Or do you think we should kind of roll the dice for a little bit? I will certainly give them my professional recommendation there. And there's a lot of factors that can go into that. But I also kind of jokingly tell people sometimes I'm not the best person to ask, because when you sit on this side of the table as the mortgage loan officer, kind of where your brain goes is people make too big of a deal out of the interest rate.
Yeah.
Just like people, in my opinion, make too big a deal out of emptying their life savings to avoid $37 a month in private mortgage insurance payments. People make too big a deal out of the rate. Is there a difference between 7.5 and 5.5? Absolutely.
Yeah.
Is there a functional difference between 6.5 and 6 3/8? Not really. When your mortgage payment's $3,500 and we're worried about $62 in the payment, it's the last $62 isn't the problem. It's the first $3,500 is the problem.
Right.
If that's where our mind's going to be. So a lot of times that's what we're doing. We're just kind of counseling people to not get caught up in the interest rate. Pay attention to, can we afford this payment? Does this work with your budget, with your lifestyle, with the future goals for your family?
Because ultimately, the same thing's going to be true in 5 years, no matter which house you're in. You're earning equity. The home prices in DFW are going up. I read an article the other day about what they're now referring to this part of town as the Westoplex. So anything from Fort Worth out west, Parker County, Hood County, Johnson County, all of these counties that have been rural for all these years, There's this article referenced that the land prices here are so much cheaper, and so we're going to see a big drive of more real estate coming this way, because if you look out north and east and Frisco, Prosper, Salina, I mean, they're busting at the seams, and the price point to get new construction on the ground there is $500,000 and up. And so I do think we'll continue to see out here a push on equity positions going up and people making money on their real estate, but also making it more challenging for buyers to get into the market if they don't kind of time it now, I will say.
Yeah,
when
but
you've got you and I in a room and we're both buying and selling in the last 365 days, that tells me something. If the industry professionals are looking at it as a good time to move, it's a good time to move, because that's when you're going to get your deal.
yeah, and the best time to buy is always now, because as we've talked at length before, regardless of how hard the lump in your throat is when you swallow looking at the list price today, in a year it's higher, in 2 years it's higher, in 3 years it's higher.
Right.
So it's all trying to time the market is somewhat futile. It's just when you as an individual or your family have needs for a new home, that's the right time to do it. And the other kind of unheralded element that often gets lost, that I talk about with people a lot, is a payment might be doable but a little scary right now. Well, 3, 4, 5 years from now, that payment probably won't faze you. As incomes go up and people change jobs, people don't typically take a pay cut to change jobs. They take a new one because I'm going to go work for this company instead because they're paying 25% more. The story that I've often told comes from my dad. He has told the story that he remembers driving to the title company in 1977 when he and my mom bought their first house, and he said to my mom in the drive, he said, Yvonne, I don't know how in the world for the next 30 years I'm going to be able to afford these $299 a month mortgage payments. And then you fast forward and everybody just, chuckles at it.
Yeah.
It's the same thing. Even when Erin and I, my wife, bought our current house that we recently sold in 2013, it was a doable payment, but I mean, I noticed it leaving the bank account. Well, 13 years later, I didn't notice it leaving the bank account anymore.
Right.
And just like the payment on the house that I bought now is like, it's a little beyond where I would want to preferably be, but I also know in 5 years or 10 years, it'd be like, man, glad I bought when I did.
Yeah.
Because that house would have cost 30% more if I'd waited a couple of years.
Well, and too, kind of what I'm seeing, the high price points, like I've had Shane's parents looking for a few years now, and the stuff in the multi-millions has almost doubled. Like, It is outrageous. And so to me, it's just like, now's the time, it's not getting any better. Okay. So if we had to wrap it all up in a bow and say, okay, what do we think is going to happen, crystal ball or not, in the next 6 months in real estate, what would you say?
I think this spring and summer is going to be pretty good. I mean, on a personal level, I mean, I'm kind of swamped right now. I know you've got, I think, double-digit listings, plus buyers that you're working with right now. So I think there's good reason to think that it's going to be a healthy market. One of the things that I track for me individually is every quarter the average number of loans closed per month over the last 12 months. And I just recently did the January, February, March, this first quarter of 2026. And if I take that back to the same time frame in March of 2023, from March 23 to March 26, it literally makes a smiley face.
Yeah.
And 2024 is the middle of the mouth.
Yeah.
And so, we're seeing kind of that curve where we're starting to get back to where we were prior to kind of the collapse of the housing industry of the last few years. So personally, I'm very optimistic. From an interest rate perspective, if we can get things with Iran kind of in the rearview mirror, I think it's reasonable to think that we get back down to the pretty close to 6%, 6.25%, 6%, somewhere there. If we got really lucky, maybe we trickle into the high fives. Realistically, by the end of the year, I don't think we get any lower than the high fives by the end of the year. So if we've got borrowers who, they're in the mid sixes, they're in the low sixes, cut bait and make an offer on the house. I would not roll the dice hoping to save $42 extra on your $4,000 payment.
Well, like you said, I'm carrying I think I have 11 listings currently, which I don't know if that's the highest amount of listings I've ever had at one time, but I'd venture to say it's pretty dang close if it's not. I'm seeing kind of a mix of all things. And so, like I said, I've got a lot of first-time home buyers who are really excited, a couple of first-time home sellers who are really excited. Overall, I was looking back at a Facebook post after I made the one that I made this morning talking about the inventory I had. And in my memories last year, I didn't close anything for a full quarter last year. And so I would say if it's any indicator from last year to this year, it's definitely busier than it was last year, which I think just goes to show you that people are kind of done chasing the whole rate game there. If they want to make a move, they're making a move. I've got people who are selling that house to put money in the bank to do something later. They just kind of want to sit tight and see what they're going to do. I've noticed people liquidating their land a little more, just raw land. And so, which is interesting because I saw a statistic the other day that land has literally doubled in value in the last 3 years. And so you think that would be something you might want to hang on to. But, you know, when it's a deal, it's a deal. So I honestly, it's the Wild West for me. I never know. I don't know. All I'm going to do is serve people well and show up, and hopefully it, you know, works out.
Yeah, absolutely.
But okay, well, this is, I think, been a great update for our clients and kind of letting them know where we're at, what we're thinking. And obviously, we're always here for them if anybody's ready to make a move, and would love to talk to them about what that would look like. And there's ways that we can get them into home ownership. And if the rate is the thing, then we'll get some seller paid closing costs and we'll buy the rate down.
There you go. So, well, very cool. Well, always enjoyable to be with you.
Yeah, right back at you. We'll see you next time.